The dollar for sure is like the number one thing I look at on a daily basis because of the Fed. Like if it wasn't for the Fed and the tightening and how the market's hinging on every word, then for me the dollar wouldn't be as important. But literally every time, like if you look at the dollar today, right? The dollar's having this green candle. This is a daily chart. So the dollar's up today. And if we go to the S&P 500, the S&P 500 is having a down day. So everything is working inverse to that, including Bitcoin, right? So Bitcoin's not having a big down day, but again, there's a down day on it. So you are seeing the dollar having that impact. So I know, and what's so cool about this is that it's like you look at this trend line, and I don't think it's hard to do, right? All you're doing is it's almost like, remember, like connect the dots back when we were
Yes.
kids. Like, I mean, that's really all you're doing. You're just connecting highs, and when you come across a connection like this, that every time it hits, you're getting these pullbacks. Well, then just play for that again. If it gets to the line, be disciplined, wait for it, and then play the pullback. And you know, again, it's a probability thing, so it's not going to happen every time. But if it happens 7 or 8 times out of 10, you're going to make a lot of money.
Dang, this is so interesting. So, particularly, so you were saying like when the dollar falls, like on the chart, that's when you would go and play something like gold. Why?
Yeah, so the key is, yeah, when the dollar tops out, so when it's going to fall, you would play gold. And the main reason is because gold is traded in US dollars.
Yes.
So when the dollar weakens, gold by default will go up. So they have this kind of inverse relationship between the two of them. And same thing kind of with Bitcoin. It's just Bitcoin's a little bit more. There's a few other factors in there, like the fear trade and like some other things. But in general, I do think Bitcoin gets to that point where it becomes that safe asset versus you know, stocks and stuff like that. So the dollar for sure is like the number one thing I look at on a daily basis because of the Fed. Like if it wasn't for the Fed and the tightening and how the market's hinging on every word, then for me the dollar wouldn't be as important. But literally every time, like if you look at the dollar today, right? The dollar's having this green candle. This is a daily chart. So the dollar's up today. And if we go to the S&P 500, the S&P 500 is having a down day. So everything is working inverse to that, including Bitcoin, right? So Bitcoin's not having a big down day, but again, there's a down day on it. So you are seeing the dollar having that impact. So I think the dollar is the number one thing. And then for me, I do keep an eye on like the yields, which are interest rates. I don't know, you know, whenever people want to buy houses or whatnot, I mean, God knows it's really gotten expensive now to get a mortgage because the 30-year, I think, is a north of 7% versus it was 3% not that long ago. But this chart as well, and you can see that this chart's right. This one's actually piercing the line. So I do actually think this starts to pull back here in the not too distant future as well, based on this trend line here. Yeah, so I don't necessarily compare Bitcoin, but I think it's important to follow charts, and I'll show you one like
Yes.
let me look at the pound here, the British pound versus the dollar, because this is an important one. So if you look at this is the British pound, and what we know is that just 3 weeks ago, the Bank of England came out and it actually kind of started QE again because the pound was collapsing. They had to come out and try to support the British pound. And what was fascinating about this is not only did you get down to the $1, it was basically on par. The pound was on par with the dollar, so meaning it was equal value. But what's fascinating is if you look at charts, the chart kind of gave us a heads up. Look at this. If you go back to 1984 or 1985, look at the low there, and then look at the low that was hit on the pound. And so you basically, in terms of, I mean, this is how far you have to go back with currencies. That's what we call a double bottom, and it's support, and you should get a bounce in the pound. Well, guess what happens to the pound? It bounces right off that trend line and comes up. So again, charts give us that insight to kind of figure out what's going to happen. And then the other thing to keep an eye on, this is actually a trade I put on today, is the dollar yen is right by 150 and right into a trend line here. And I don't have a random trend line there. We can get rid of that. But look at this trend line on the dollar yen, and you're right into that level, right by 150. So I actually went short the dollar yen or long the yen today. It is so cool. Yeah. I mean, I love this. I love the fact that every day I sit down behind my computer, right? And I don't know what I'm going to discover. It's like being an explorer. And I'm like, I'm not sure if I'm going to make $1,000 today, 5,000, 10,000, or maybe I'll lose today. But it's that excitement. It's almost like you get to gamble, but in general, if you get good enough, you're going to make money doing it and become a professional, like winning gambler. Yeah, yeah. In fact, I just launched this new 3-course series. It's called the Winning Trader series,
Do you
and
have a link?
literally everything I know that's up here for the last 20 years, all my mistakes that I've learned by everything from analyzing your own discipline and mentality to the market psychology to the charts, like everything I know I put in this. There's 3 courses included in the bundle, and it's 20 hours long, like of me just teaching, and we debuted it in August, and it's called the Winning Trader series. So, and by the way, if you don't mind me mentioning, it's at verifiedinvestingeducation.com. But it is like, it will blow your mind away, like the stuff I reveal in there about how to read charts and kind of understand the market. Oh yeah. So this is the tricky thing with stop losses. It's always good to have a maximum that you're willing to lose in a position, which is why you have a stop loss. The problem is that psychologically, all retail investors like to put them at even numbers, because it's like, think about something that's like, let's say it's $25. Where would the most common stop loss be? Well, you'd say, all right, well, if it breaks $20, I'll stop out. The problem is the algos and the bots and the institutions know that. So guess where they're going to push the price? They're going to push it right to 20. You're going to get stopped out, and then price is going to go back up. So what I always recommend to people, if you're going to use stop losses, and you should, especially if you don't have the discipline to do it without one, make sure to put it at weird random levels. Put it something like instead of at $20, put it like 1977, or like, something random where everyone else won't put it, and then you're less likely to get taken, if you will, by the bots and the algos.
That's so freaking interesting. Because that's so true. Like, people rather have like that even number and just be like, oh,
Right.
okay. Like,
It's human psychology.
Whoa.
We just get attracted to these round numbers and everything like that. So you have to learn these games, and then you start to actually do a lot better as an investor or trader, because you avoid some of the pitfalls.
Yeah.
Yeah. I mean, I'll just show you guys one more thing that's pretty cool. So
Yes, please.
let's go to oil, right? So one of the big calls this year was when Russia invaded Ukraine. Everyone and we're talking analysts on TV, they were all like, oil's going to $150 to $200 a barrel.
Did oil go to
Everyone was
zero?
like, and I remember posting it on Twitter. I was like, guys, oil's going down. The charts are saying it's going down.
Yeah.
And everyone was like, no, you're crazy again, which is normal in my career. People call me crazy, but that's okay. I like that. All right, so look at this. So what I wanted to do here is let's go to the 2008 high. Okay, and basically what we're going to do is we're going to connect these lows here. So we're going to connect the low from 2008 to this low, and we're going to drag it through. Well, basically what we see is on the COVID collapse, we went right down, we pierced it, but really we didn't do much more. We kind of stopped right there. So now we have a trend line. Now what we'll do is we're going to raise a parallel line up here, and what do we get? Look at this. So, and now just drag it out here. And look at that. So basically what we had, and look at how this line is perfectly parallel with this line. And this is how I knew that at $130, price was going to stop, because you have this beautiful parallel line, and I use parallels in trading. And at 130, when Russia invaded and everyone was saying 200, we saw this go up, tag an exact pivot point from there with a parallel line down here. So again, that told me, okay, guys, look at the chart. I mean, every time it hits here, it bounces. Well, then same thing. Here it hit, pulled back. So in that theory, you should see a pullback here, and that's exactly what we saw. So just cool things like that. I mean, just playing around with charts. You don't need a million indicators on the chart to confuse you. Just draw some trend lines and find out what you find.
Because
I've never seen oil go negative in my life. Basically, they were paying you to buy oil at that point. Now, just to give you an idea, it really wasn't as sweet of a deal as you think, because when you're dealing with futures contracts on commodities, if you hold it into expiration, you actually have to take delivery. And I think one contract's like 10,000 barrels of oil. So the reason why price went negative and people still weren't like, oh my goodness, this is the greatest thing in the world, is because at the end of that contract, you would have had to take delivery of 10,000 barrels of oil for as many contracts as you own. It might have even been more than that. It might be 100,000. I'm not sure what it is, but the point is, you actually have to store that oil somewhere. You have to have it, so it would cost a lot of money. But that's what happened, is that you saw this kind of panic sell off. A lot of funds got caught. Then they had to unload. Then price went negative because people didn't want to take delivery, and it got crazy.